Hey guys, Dave Keller here with Market Misbehavior. A number of my guests on StockCharts TV this week have focused on small cap stocks, and the reason is because the Russell 2000, the S&P 600, two common small cap benchmark indexes are both breaking out to new highs. So today we're going to talk about small cap stocks versus large cap stocks. So very simply, small cap stocks are the smaller, riskier, higher beta, meaning higher risk, higher volatility types of names. They tend to represent a risk-on mentality, meaning when we're ready to take on additional risk and bet on the markets improving in general, we can express that by buying small cap stocks. They tend to be a little more volatile, a little more uncertain, a little less proven, smaller, more higher risk, but higher potential reward. And so when we think the market is most likely going to go higher, a lot of times institutions will make a larger bet on small cap stocks versus more conservative, blue chip, defensive, large cap names. So the ratio of small cap versus large cap a lot of times can tell you about where investors are making their bets. We're going to look at a series of charts that talk about the reality about small cap stocks and your experience owning small cap names versus large cap names over the last year or two. And we'll focus on why it's an important tactical move right now. Before we get to the chart, as a reminder, if you like this sort of thinking about technical analysis, behavioral finance, trend, momentum, breadth, sentiment, all the above, if that's of interest, hit subscribe, would you? Also, give the video a like if you appreciate it. We'd very much appreciate that back. Finally, put a comment below. Do you see small caps outperforming large caps through the end of the year and into 2022? If so, why? And if not, why not? Let's get to the charts. So I was told by one of my former analysts when I worked at a large buy-side institution that charts are the truth serum for the markets. They will tell you the reality of how the markets have evolved. So what is the reality of small caps versus large caps? So here we're looking at four different indexes. You can see the tickers in the upper left. We have the SPY, the large cap index, MDY is the mid cap index, IJR, the small cap index, IWC microcap index. And this sort of loose guidelines to what these different cap tiers means, but it's basically the size of the market cap, right? So large cap is represented by the S&P 500, and usually it's above about 10 billion or so would be a large cap stock. Mid cap would be sort of in the 2 to 10 billion range. Small cap sort of in the 100 million to 2 billion range, and then micro cap anything below 100 million. Those are general guidelines, and I've seen people use different settings for those. That's by no means a hard and fast rule. Those are the general guidelines that people pay attention to. So this is showing you the types of these companies and these major benchmarks and how they've evolved over time. So the S&P 500 over the last 6 months is up about 12%, just under 12%. You can see that here in black. In green, we have the small cap index, which over the same time period is up only 6.3%. The mid cap index right at 6%, and the micro cap index, the smallest companies, up 5%. So why do we talk about the dominance of large caps, the FANG trade sort of dominating everything else? This is an example of what has happened over the last 6 months. It's been large caps while everything else has been relatively sideways, really until the last week or two. Other than that, it's been all large caps. So for most of the last 6 months, mid caps, small caps, and micro caps have been relatively choppy sideways, while the large cap index overall has been moving up and to the right. But here's the trick, right? With data, you can make it say a lot of different things. And with charts, unfortunately, if you're not careful, you can find yourself creating charts to make sense of to make whatever point you want to. Here's the same chart, but instead of looking at the last 6 months, we're looking year to date. Now, when you start the clock on at the end of December of last year, you can see the large caps are up about 25.5%. Again, a lot of that's come in the month of October. The end of September was down here in the 16, 17% range for the year. Had a pretty decent October. November so far is moving higher, 25.5%. The mid cap index up 26.3%. The small cap index just under 30%. The micro cap index, the best, almost 31%. So if you look year to date, you can see that it's actually been everything but large caps that are working. So how does this make sense? Where on one chart, looks like large caps are the best, and on the other chart, they're the worst. So if you look at what's happened year to date, in the first quarter, that's where the small caps, mid caps, and micro caps all did exceptionally well. And it's based on the sector leadership. You see the mid cap and the small cap indexes in particular are a little heavier weighted in certain sectors. They're weighted in some of the more value-oriented sectors like financials and energy and raw materials, basic materials, things like that. The large cap index The S&P 500 is much more weighted into consumer stocks, technology names, communications names. So when those growthy sectors are doing well, the S&P tends to outperform. When the value-oriented, more cyclical sectors are doing better, the mid and small caps tend to do well. So if you think about what actually worked in the markets in the first quarter, really through May, it was financials and energy that were doing really well. And that's why those other captures did well. But look at how the purple line representing microcaps really has been sideways for the last 8 or 9 months. And that's what's happened, right? So over the course of 2021, it's actually been better to own other things other than large cap stocks until just recently. Large caps have actually been the worst performer out of the three, although again, they're all up 25 to 30+%. Let's go a little further though and take the clock back to the March 2020 low. Now you can see that the large cap index is up 107%, 108%. The mid cap index is up 134%, small caps up 143%, and micro caps up 165%. So if you had perfect foresight and you bought on the day of the bottom and owned the S&P 500, you'd be up 108%. If you bought the small cap index, you'd be up 143%. So you would have outperformed by 35% just in the last year and a half, based on which of those captures you bought. So that is when people talk about the performance of small caps in bull market phases. This is what people are thinking. In general, when the market's doing better, the smaller companies tend to do better because they're a little riskier. That's the way that you would express risk on, that you really think the market's going to go higher. More often than not, in bull market phases, small caps tend to outperform large cap stocks. So why are people so excited about small caps breaking out? And here's why. If you look at the chart of the Russell 2000 ETF, the ticker's IWN, that's the top half of the chart. The bottom half, I just have the S&P 500. It's a familiar chart to many of you. You can see what the price has been doing. Look at how the S&P chart has been fairly consistent up and to the right after that September and October period of last year. From then on, it's been a pretty consistent uptrend. But if you look at the Russell 2000, again, it did very, very well into March. And then from there, it's essentially been sideways, right? And so that's what I mentioned. Most of the gains for small and mid caps actually happened right at the beginning of the year. From then, it's been relatively sideways. But look at what's happened now. The Russell 2000 has been range bound for the last 6 to 8 months. And now it's just breaking to an all-time high. So while the S&P and the NASDAQ have made consistent new highs every month for the most part, the Russell 2000 has been unable to do so since March, and it's just finally breaking out this week. Same with the mid-cap index finally breaking to new highs. This was a chart I actually featured months ago, back in April and March. I had a series of charts, and I called this the chart, which tells you how important I thought it was at the time. This is the S&P 500, and then 4 measures really of market breadth. The blue line is showing the advanced decline line. I have a series of videos on this channel talking about breadth conditions. And if you've missed those, I'd encourage you to go back there, because the advanced decline line for the New York Stock Exchange is rotating higher, which is very encouraging. Here we have the equal weighted consumer discretionary versus consumer staples. This is looking at whether investors are betting on the offense or defense within consumer discretionary versus consumer staples. And overall, this is trending positive, which is another check in the bullish column. At the very bottom, we have how many new highs we see every day on the S&P 500 and how many new lows, which would be in red. You'll notice very little red because there are very few new lows, but plenty of green. And a healthy bull market phase should see an expansion in new highs. So I'd be looking to see if those green bars can continue to appreciate. That brings us to that purple series, which is the ratio, the relative performance of the Russell 2000 versus the large cap index, the S&P 500. You can see that that ratio is going higher through March as smalls were outperforming large. From March through really August, the ratio is going down as small caps were underperforming the S&P. This is as the Russell 2000 was flat, as the S&P was going higher, which we saw in the previous chart. Look at what's happened in the last 6 to 8 weeks on that ratio. It stopped going downwards, started going sideways, and now potentially is breaking out to a new 3-month high, which confirms the fact that while the S&P has had a pretty good run, small caps are actually starting to participate. When I think about the seasonally strongest part of the year, November, December, which we're just beginning, small cap outperformance would play in very well with the idea that investors are bullish, that they're encouraged by the prospect of higher prices, and as a result are putting more of the risk on trade, which means they're more likely to buy small caps here than large caps. So that is the idea between small caps versus large caps. We looked at some historical trends and saw, depending on your time frame, you'll see why why people are very excited about the Russell 2000, the S&P 600 small cap index breaking to new highs, because they really haven't been doing much over the last 6 months. But if you look since the March 2020 low, it's been all about risk on versus risk off and looking at small and micro caps versus large caps. Finally, we talked about the ratio of small versus large and how that ratio is starting to turn higher, which I would argue represents investors and especially institutions making more of a risk-on posturing in November and December. And if nothing else could make you feel more confident about the bullish phase of the market, that's one thing that I would certainly be looking for. So what do you think? If you like this sort of discussion about investor behavior through charts and technical analysis, if that's of interest to you, I hope you'll subscribe to my channel. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Finally, put a comment below the video. What do you think about small cap performance November, December into January? Outperforming large caps or not, and why? Let me know in the comments below. From everyone at Market Misbehavior, I'm Dave Keller. Be well, stay safe, have a good one.